As central banks raise rates to keep a lid on inflation, the Fed yesterday, the ECB most recently today, one word does keep popping up, and that is diversification. We often talk about investors needing a more sophisticated toolkit, but what should go in there? What are the tools? For many investors, one place to look is real estate, considered by many as the ultimate asset, alternative or otherwise. And REITs, or real estate investment trusts, are one way to play the space. Blackstone, a major figure in that sector, its privately held BREIT has a net asset value of $68 billion, which much of its exposure in rental housing, industrial, and data centers. Joining us now is Joan Solotar, Blackstone Global Head of Private Wealth Solutions. BREIT is under that, but there's much more in your purview. Thank you so much for being here, Joan. We appreciate it.
Thank you for having me.
So let's talk about real estate right now and how investors should be thinking about it in their portfolios, right? Because we're sort of at a delicate moment, if you will, in the market. So how are you talking to people about it?
So I'll talk about real estate specifically, but I think just thinking about portfolios, if you go back a little bit in time, you don't have to go back too far, the 60-40, 60% stocks, 40% fixed income was the mantra. Performed pretty terribly a couple of years ago, and I think that really just accelerated conversation. But today, individuals are looking to invest a lot more like institutions are. So having core allocations in areas like real estate. And there's a lot of news, noise, and actual fundamentals that are pretty negative in certain parts of real estate. But you have to differentiate where you invest matters. And if you think about the goal of any investment, it's to have cash in your pocket and appreciation, and that is what real estate provides.
So give us both sides of the trade there. What are the brightest spots to be looking at right now, and what are the areas within real estate that are getting kind of investor chagrin and reasonably so?
Yes. So the most challenged today are traditional offices. Think about New York, San Francisco, high vacancy rates and the like, or retail because of the very long tail trend of e-commerce. So those I would put in the negative category. They will be challenged for some time to come. And then on the other side, think about short supply, very high demand in areas like warehouses, which has been driven by e-commerce over a long period of time, rental housing, shortage in building. There's just been this major gap really since the global financial crisis that we haven't been able to narrow, and data centers, which I think we're going to be talking about for at least the next decade. I know you've been focused on AI on your show very recently, and that is what's driving demand, and it has just exploded. And it is costly to build. You need land, connectivity to electricity, power, and the like. And so vacancy rates there are just minuscule.
Compared to a lot of other parts of the industry.
Correct.
So do you expect we showed sort of the breakdown of that BREIT portfolio. Do you expect the proportion of things like data centers to climb?
I do. We are fortunate in that we have built out this platform. You mentioned $68 billion. We have a lot of capital that we can deploy. We have quite a lot of land bank that's connected to power. And you are just seeing demand for that exploding. So this is something you will hear much more about from us over time as those get built out. And I think the other piece of it is that unlike development, when you think about development of apartments or development of office, which is speculative, these are built to suit. So you already know who the tenant is, it's contracted for, so very strong cash flow.
Now, you guys made some news earlier this year. You did limit investor withdrawals from BREIT, which
Correct.
is in your purview to do so. Talk to me about the rationale behind that and how long you expect to do that.
Yeah, it's a great question. When you're buying stocks and bonds, you can trade those on a daily basis. When you're choosing private investments, you're making the decision that these are less liquid. So the building across the street It doesn't change in value on a daily basis. You don't sell it in a day. And so you have to be able to match liquidity in the portfolio with the liquidity that you're providing investors. And so we put these caps in place as a safeguard to be able to do that. And I think what has proven out is that good performance has continued even though we had the caps in place. And that just provides a lot of confidence to the investors in the fund and to prospective investors.
Now, as I mentioned in the beginning, BREIT isn't the only thing under your purview. You've got the private wealth solutions, bigger piece of it. What are you hearing from your investors right now? How are they feeling? I mean, and we're talking about mostly high net worth individuals, right?
Correct. They are feeling better. I'd say we moved from negative to neutral. Part of it is, of course, markets are healing. We think you have seen probably the peak of inflation. That certainly seems to be coming down. Investors are able to earn 4.5%, 5% in their savings accounts. You have a big wall of cash that will probably get redeployed. So the conversation is much more around where those investment decisions are going to be made in the second half of the year in 2024. And I would say, even just a few months ago, the conversation was much more around downside risk, what could go wrong. So you're seeing investor confidence move from negative to neutral, and my expectation is that will continue.
How would you marry what we're seeing within construction right now of new real estate starts with where the current state of the industry is, and what that kind of spells out from an investor opportunity or perspective, even going into 2024 too?
So it's a good question, and you have to look at it by sector and by region. So if you're talking about housing, if it's houses for sale, that's a very different dynamic than houses for rent, which is where we're invested. So there's not a lot of movement in houses for sale. There's actually a pretty big drop in housing starts. So new supply is very low. Demand is still there. Interest rates are high. So if you're thinking of buying a home and you currently have a mortgage where you're paying 3% or 2 and change, it's kind of a hard decision to then say, well, I'm going to buy and now I'm going to pay much, much more than that. People are staying put. That means on the rental side, because you haven't had new supply, just demand continues apace. All that said, the pace of rental increases has definitely slowed. When we look across our entire portfolio, it's still quite a healthy 7% cash flow year over year growth, which for real estate is actually quite good. But when you think about where rental rate increases were and where they've moved to, that's one of the big drivers of inflation coming down.
Interesting and really valuable insights and perspective. Thank you so much for joining us here in studio.
Thank you for having me.
Absolutely. Joan Solotar, who is the Blackstone Global Head of Private Wealth Solutions, here in studio with Yahoo Finance.